So what are the 4 loan options you need to know about as a consumer, and what are the 4 mistakes you want to avoid when buying a home? Buying a home. I'm Jaime Lizalde, and welcome back to Real Estate Unlocked. As you know, every week we sit down and we talk everything real estate and have a couple of laughs. And today I have in one of my good friends, one of my high school buddies, Mark Ferguson with Gill Mortgage. Welcome, Mark.
Thank you, Jaime. I appreciate the time, and I love talking about loans, so let's get to it.
Yeah, let's get to it.
What's the biggest mistake buyers make when they're choosing a plan?
Great question. I think kind of 2 things kind of pop into my mind. First, focusing so much on rate that they lose focus in terms of what goes into the loan program, rate, fees, mortgage insurance. I think that's a big one because I get so many phone calls. What's the rate? What's the rate? And that's the only thing they focus on. 2, what's their overall budget? What's their financial budget? Not just for the mortgage itself, but other things as well. Simple example. They have so much money, they only focus on the mortgage. Well, what do you have outside of that? Do you have a car loan?
Yeah.
Every $10,000 in mortgage is $60 a month. If you have a $500 auto payment, that's $80,000 in mortgage.
Yeah.
That's an increased buying power. Use the money to pay that off. Give yourself some more buying power. It's a net positive.
I just, it blows my mind how many people will come in here and complain about, oh, the interest rates are so bad right now in a house, right? They're high. I'm going to wait till they come down. And I go, I'm sorry, you showed up in a $60,000 truck at 8% interest or 12% interest that's a depreciating asset, yet you won't invest in a home that's going to gain equity. And again, like you said, they're so lost, they're so short-sighted. I feel it's short-sighted. And again,
absolutely,
it's not that, it's just lack of education. It's lack of trusting realtors and lenders that we have your best interest, right? But the reality is, it doesn't seem a lot to buy a car, right? Oh, it's 5 years. But when you add the interest and you add that up and you look at it compared to a house,
absolutely,
they're bad investments. And I always tell people, like, look, you can buy the house and get the car tomorrow. You can't do it the other way around.
Absolutely.
Yeah.
I think I've seen some crazy, very large auto payments, and it's having that, straight to it, here's the real deal. What's your biggest priority? Do you really want to buy a house, or do you want to show out on your ride? And sometimes it's a matter of having an honest conversation.
It is, and I get it. I mean, it's always nice to have a nice car, but do you want to park your nice car at your apartment, or do you want to park it in the garage of your own home?
Absolutely. That's a very good point.
Yeah. So the other thing I also notice when it comes to this is you said something about having reserves. As somebody like in the Hispanic community, we're really big on, I want to see the money in the bank. It's my safety net, right?
Absolutely.
So I don't want to give a lot of money down. I don't want to, but like you said, the smart move is to pay down sometimes these other loans that are hurting you and limiting your buying power when it comes to a home loan.
It's short-term success in addition to long-term success. It's trying to pair those together. That way, what's your biggest priority? How can we set you up? And also, let's not, redo it again later on. Yeah. Let's set you up and let's have a conversation again for the success, not only for short term but also long term.
I agree.
Let's dig into FHA loans. Who is that best for?
I say it's better for those that have lower credit, maybe limited funds. FHA also has a little more flexibility when it comes to your overall DTI. That stands for debt to income. Right. That's the simple math. How much money do you make? How much do you have in liabilities? That's where the car payments come into play, right? That kind of impacts your overall qualifying. So I think that's kind of the biggest key is FHA has those few different parameters to consider.
Now, I know right now as a realtor, we're all pushing FHA. Where, a couple years ago, nobody wanted an FHA loan. Nobody was touching an FHA loan. But again, I feel that they're most popular. In my words, they're also the most forgiving, right? Like he said, the most debt to income. They allow you to have certain things, lower credit score. I think for the general public, for most first-time home buyers,
absolutely,
FHA.
It's typically the easiest loan to get qualified because you have those flexibility. You can go a little bit low on your credit score. We can always work with you, try to get it up, but it gives you that a little more access to purchasing if you utilize an FHA. There's some pros and cons there.
So let's talk about a con of an FHA loan. Let's dig into that, because I know once we go under contract, or there's certain homes that I see that I tell people we can't make an offer on because we have an FHA loan.
Yeah, you could dive in pretty deep to it if you want, but really is the home safe and secure, right? Yeah. Is it sound? Like different things that come into play. FHA appraisers are going to nitpick. They're going to find certain things that could potentially ruin a deal. So you want to be heads up. You want to make sure you get your inspection. Inspection is going to give you a little bit more of a, here's what we can anticipate. And we don't want the appraiser to come in and start, killing a deal.
And I think it's very important that you have a knowledgeable, experienced agent with this. I'm going to tell you, as somebody who's done this for a long time, I've seen homes that are listed as FHA homes that are acceptable, and we get there, and let's say it's a trailer with no skirting and no stairs, and or there's holes in the floors, or the siding. I saw one the other day where all the siding on the back of the house was burnt, and yet it was FHA.
There's a story there.
And I'm like, again, you need to understand that there is a loan for that, but it's not FHA. FHA wants the house to be livable. They don't care that the carpet's green. They don't care that there's green wallpaper, right? But it has to, right? It has to be livable,
right?
And which again, most houses are, but a lot of times I'll get an FHA buyer who's like, I want a deal. I want to flip homes. I want to fix her up.
So if there is somebody looking for a fixer-upper or to invest, what type of loan would that be?
Conventional.
Yeah.
Conventional is the way to go, and that's kind of a catch-all, if you will. Ideally, you want to have a little higher credit. You have a little bit of down payment. If you're buying it as a primary residence, you can put a little bit less money down. If you're buying it as an investment property, you're going to have a little more to put down, more like 20-25% down. If you're thinking about the fix and flip type thing, if it's your own personal home, great. The higher your credit, the more advantageous your terms will be.
Yeah. So conventional definitely is good. Higher income, higher credit score, because there's less fees involved with conventional loans.
Yeah.
But they're a harder product to get qualified for.
Right.
But as investors, they're really good. I mean, I know that like some of my banks and some of my loans are like, hey, if you give me 30% down, I don't care what the house looks like, as long as it praises out, we've got the security of your down payment. Also, if you're an investor, if you're thinking of flips, talking to your lender about adjustable rate mortgages is not a bad idea.
They're coming more into play now. They're more, like for a little while, for the previous couple of years, ARMs were not a great option. Conventional fixed was but we've actually been locking some people in some ARMs. Gives you some good value, maybe a little bit lower interest rate. I think something to touch on in the conventional, especially to compare to the FHA we already talked about, is the mortgage insurance, right? The mortgage insurance is key. The difference between the two, on the FHA, you're going to have mortgage insurance for the lifetime of the loan, unless you're putting at least, say, 10% down. But it's something that could potentially go away later if you refinance the home. Conventional, you're going to have mortgage insurance if you put less than 20%, but there's an avenue for that to go away if your principal balance goes low enough to where it's like 78%, it's like automatically goes away. So those are the two things to consider. Have a good conversation, talk about the options, and that way, depending on your context, what you're trying to do, that can definitely kind of steer you in one direction or the other.
And I think also something I'd like to mention about FHA and conventional that's changed was when the new administration have come in, they've changed who can get an FHA loan. Before it was citizen, resident with a green card, work permit, and DACA. Mm-hmm. Now they've switched it. So if you're DACA and you have a work permit, you can no longer qualify for an FHA loan, which sucks. I'm sorry. It's a stupid rule. We just want to talk about how this is affecting you guys. So I do get people come in and go, but my uncle bought with you, and it's 2 years ago, 5 years ago, completely different.
A lot has changed over the past couple of years.
Yeah.
Everyone is different. Everyone's credit score is a little bit different. Everyone's financial situation is a little bit different. So
I still get guys who ask me if Obama's still giving $10,000 for free money. I'm not joking. So depending on how long you've been in this business and how long you've been looking in real estate, there was a time when the government had programs that were giving money. It was forgivable as long as you didn't sell your home. Mark, do those exist?
Quick answer, no.
No.
No. There's, like we talked about before, there's some DPA programs. There's some, we got some creative financing that we can potentially do, but there's no such thing as free money.
Yeah.
I think that's the biggest point here.
There's no
longer.
such thing as free money.
Right.
There is zero down. We have done zero down programs before.
Absolutely.
There is zero down for the right person and the right. But again, that's a conversation you don't want to ask your uncle, your friends, your buddy, your unexperienced realtor. You have that conversation with a lender to see if it really benefits you to go zero down or not.
Absolutely. Having a good team on your hand is important. People that have been around the block a few times, and we've closed a lot of loans. We've talked to a lot of people. We've seen one end of the spectrum or the other. We've seen a little bit of everything.
Yeah.
So we have that experience to give you some good feedback.
Now, I think talking about zero down, I think that led to the next question.
USDA, the zero down program.
Yeah, I mean, there's some pros to cons to that. I mean, big pro, zero down. It's great.
And it's a real loan that's zero down.
It's a real loan that's zero down.
Yeah.
Now, the cons there is it's based upon where the property is located. We got to run an address through the USDA. If it's eligible, fantastic. We can explore that option. Usually you have a little stricter guidelines when it comes to a few things. Your income and your overall debt to income. Typically there's a little bit lower DTI threshold. So it could be a fantastic, very valuable loan product as long as you're meeting a few different thresholds.
That's where I find that it killed us is one, the debt to income. In other words, your buying power is so limited,
Right.
and especially if you're in Austin, the prices are so high that I find that it gets really tough to do USDA. The other thing, as we talked about, is the location. So basically, the way of looking at it is you have to be inside the county but outside the city. That's a rough way of looking at it, right?
Yeah, it's
So,
gotta be rural.
yeah.
Usually a city that's maybe less than 35,000 people, that type of thing. So you're more outskirts.
But it doesn't mean you have to buy a ranch. That's not what that is.
Absolutely.
USDA just means there are certain new home neighborhoods like in Del Valle right now,
Right.
in Elgin right now. Those all meet USDA standards, brand new homes in cookie cutter neighborhoods,
Absolutely.
and you can go zero down.
Yeah, absolutely.
Is there a site or somewhere where people can look up USDA for realtors?
Absolutely. There's a USDA website that you can go and look up an address and see if it's eligible. If it is, great. Give us a call. Happy to crunch some numbers.
What are some of the income limits buyers should know about USDA?
Usually it depends on the county, strictly dependent on the county, and it depends on the size of the family. I'd say Travis County and kind of surroundings is probably about 110. Usually it's like 80% of the AMI, which is about 110, give or take a little bit in terms of your total home income for 1 to 4. 5 to 8, it gets a little bit higher.
$110,000 is you still qualify, right?
Absolutely.
You still qualify. Above that, you don't qualify. Is basically what we're trying to say.
Mm-hmm.
But also, again, great example. If you make $100,000 and you're on an FHA loan, we're probably going to get you to a $450,000 home.
Absolutely.
On USDA, you're probably looking at a $350,000 home.
Yeah.
That's the difference in buying power between USDA and FHA. Again, both great programs, just a little bit different in certain things. Yeah.
So there is another zero down program for veterans. Can you
Absolutely.
talk a little bit?
VA loan is a fantastic. It's potentially the best loan program. As long as you're a veteran, you could be active in the military as well. Zero down for anyone.
Yeah.
As long as you're eligible, zero down.
There's a couple other things too. Like I mean, correct me if I'm wrong. Like they're also more forgiving with debt to income and other stuff, right?
Credit scores, DTI. I mean, like we've talked DTI numbers. It has the highest DTI that you can go for. I've seen upwards of 60, 65 DTI on a VA loan. Gives you a little more leeway. Credit scores, less impactful on the overall qualifying. Really, are you a veteran? Great, we got a loan for you.
Yeah. Wow. So if you're a veteran, 100%. I just sent a client to Mark that we're working with that's a veteran.
There's guidelines across the board that it's not unique to one specific lender. VA is VA. We can do it. We can handle it. I think the key, and you might even be kind of leading up to this, is the VA funding fee. I think that's super important. But what I've found is a lot of veterans that I talk to have service-related disability. That's a key figure there, right? And the VA funding fee it's 2.16% if I get right. For first-time home buyers, it's 3%, and it's an upfront fee that you have to pay. If you have service-related disability, waived. You're exempt.
Yeah.
Is there fees that the seller should consider when they're receiving a VA offer?
I know that
for
when
the seller,
yeah, and so VA does have certain things that they don't allow the buyer to pay for. What are some of those things?
Specific closing costs
Yeah.
that kind of come into play. I think the key is making sure that we walk all those through those. Off the top of my head, I can't remember exactly the specifics, but yeah, I think now they're a little more open to those because it's more of a buyer's market nowadays, and seller concessions kind of come into play a lot.
Right.
They may be going away, but now it's super great time to buy, obviously, with those out there. And so it's a certain percentage that they can offer in terms of seller concessions to help cover some closing costs.
Yeah, that was the biggest one. The seller concessions for VA was limited. Now, again, they've kind of caught up with the times and understand.
When you're comparing all 4 of the loans, if someone has 5% down, 680 credit score, which loan might fit them best?
I'd say a conventional loan makes the most sense. Your credit score is high enough. You have a little bit of a down payment. You're going to have a little more flexibility on your conventional. We can always explore other options as well, but most of the time I think that's going to give you the best kind of short and long term, specifically because the mortgage insurance can go away over time on a conventional loan. I think that's going to make the most sense, at least kind of, big picture. Conventional is going to be the one that you'd maybe focus on the most.
Now, I have a question, Mark. So, again, going back to kind of our client that we're working with right now. Somebody watching this, well, I've had my money at this bank forever and they love me and they always tell me they'll give me a loan. Why should somebody not use their bank like Wells Fargo, Bank of America, right? And go to somebody like you with Guild? Because Guild's a bank, it's a mortgage, but I don't see the branch anywhere, right? So kind of explain what you do and why somebody would go to you.
I think it's because we only do mortgages.
Yeah.
That's our focus. We're experts in that field. Most people typically kind of fall within the box, right, of kind of your 4 main kind of loan programs. But you need somebody that's going to think outside the box, get a little creative, look at the big picture, look at all your finances, not thinking about what you're going to be depositing, your checking, your savings, are you going to be buying a CD, all those other things. We're a leader in the lending field in the industry. We've been around for a long time, and picking someone like myself and my coworkers is a very valuable tool because we're going to advocate for you and be able to know all the different loan products and all the different pros and cons.
And a mortgage person, a lender is vested in you, right? They're invested in you as far as getting this loan because, again, just like your realtor, we're not paid, we're not getting anything if we don't get you to the closing table.
Absolutely.
So the guy at the bank's getting his salary, whether he screws your loan up or not, it gives you good service. And so that's the big difference. And I know right now, unfortunately, some of my preferred lenders are losing out to these new builders. And again, this is just what the market is. And we're having to move to the builders lenders. And some of them just offer really bad, lousy service. We had one recently where they didn't get a call back for 2 weeks from the lender because they don't care. You're another number. And when you deal with somebody who is here, who's real, right? They're going to have that service. And I really believe that's why I have guys like you on to kind of showcase, me and you knew each other a little bit in high school, kind of reconnected later in the real estate field. And, your kid goes to Bowie, my kid goes to Bowie, class of 94. Great, we just dated ourselves.
Go Bulldogs, that's right.
Yeah.
Ignore the gray hair.
Ignore the no hair.
I'm almost there. I'm right behind you.
So I think it's good because, again, the experience we have in this industry can help young ones, help people who want to start off and not make those mistakes. And I think that leads to this last part. What are the 4 mistakes buyers need to avoid? Something we see all the time in this business. What would you say was the first one?
Don't go out and buy a boat.
Yeah.
Don't go buy a jet ski. They're fun. I've been on them. They're fantastic. But you're trying to buy a home. Your finances are going to be scrutinized. Let's not muddy the waters by going out and overspending and overextending yourself by spending money on that nice ride that you want to put in that driveway. Don't make that one big purchase. Wait till later, make sure your finances work, and then, make that decision.
Agree. I think number one mistake I see is somebody young gets a job, goes out and buys a car that they shouldn't, something a little bit over, their budget because they were approved for it. But again, you need to understand.
Said it was good.
Yeah, exactly. You have a depreciating asset in a vehicle. It's going down in value. It went down. I think it's like 20 to 60%, like a luxury vehicle will go down 60% the minute
you drive off.
You drive off.
That's right.
So let's understand that. The second thing we see people do, and I'm going to bring this up, is especially for my guys who are self-employed, contractors, income tax. Not filing enough income.
Absolutely. I think that's key because my wife is self-employed. I help her do her taxes. We would much rather pay less to the government. Everyone's focus is, how can I pay as little taxes as possible? Well, it's a seesaw effect, right? You can do that and it's great. You're going to pay less federal taxes, but that means you're going to show less income. And so when you want to go buy a home, you're not going to be able to afford as much as you would maybe like because you have a lot of income coming in, but you're writing off a lot of stuff. So I think the key there is have that conversation with your tax professional. How can I structure it this year? Because I have a big purchase I want to make.
And it's 2 years. They take the average of 2 years. So this is very.
Unless you've been in business for 5 years, I can do 1 year only.
Okay, cool. So that's
so there's a key there. So again, that's me having a conversation with people, finding out a little more details, and having that knowledge that hey, if 2024 was maybe not a great year, and 2025 you're killing it.
Yeah.
Let's get those taxes filed. Maybe show a little more income, and then that can help you meet your goals of buying the home of your dreams.
You make the sacrifice now, 1 time, 2 times, right? You declare that higher income, and then it gets you the house. And then guess what? I just told it. Mark's not going to tell you. I'm going to say, you go back and you start declaring net less. You start writing it all off because you got the house, right?
Yeah.
So it's a little trick you can do. We do it when we want to buy something. We kind of declare that high income. And then, just not take as many write-offs. Now, the third thing, what would be the third biggest mistakes you see buyers do when it comes to...
I've looked at thousands of credit reports, and I think one mistake that people make is not making their payments on time.
Oof, yeah.
I had a few recent clients that... They had some great income. They were going to be qualified, and there were some late payments on their credit reports. A simple credit card, maybe an auto loan. Maybe you forgot to turn on the auto payment. Late payments are the one thing on your credit report that can give you the largest negative impact, but it's also one of the easiest things for you to control so you don't have that negative impact on your credit score.
You're so right. I mean, I've seen it where one payment, 30-day late, right?
Absolutely.
Impacted the credit so much. And then how hard it is to build that number back up.
Absolutely.
Right? Like one missed thing, it sets you back 6 months.
6 or 7 years it can stay on your credit report and negatively impact it. The further you get away from it, the less impactful it's going to be. But that's 6 or 7 years that you can do nothing about unless you can somehow, finagle with your creditor to maybe take it off.
Yeah. The fourth thing that I've seen people do, and this kind of goes back to, helping somebody out, is co-signing for an auto loan, co-signing for furniture, co-signing
Absolutely.
for something that's not smart and thinking they're helping somebody out. I had a client who made good money, pulled his credit, 5 auto loans.
Yeah.
5 auto loans.
5.
Yeah.
You can only drive one at a time.
Exactly.
Right?
And again, there are some things we can do to try to, if somebody else is paying for it, we kind of prove it, right?
Absolutely, yeah. I mean, if you don't have to co-sign, I would recommend not, because if you're wanting to buy a home, that can definitely negatively impact you. But if you did do it, if it's maybe been a couple of years, typically if whoever you co-signed with, if they are making the payments out of their own account that you are not on, I can exclude it. So even though they got a $500, $600, maybe even higher payment that's negatively impacting you, if we can prove that somebody else is making those payments, even though you co-signed, we can take a deep breath and take it off.
Let me reiterate that.
Yeah.
If you co-sign for your daughter, your son, if you co-sign for your brother, have them pay it out of their own bank account
Yeah.
directly to the lender.
Right.
Even though you co-signed it, even though it's in your name, because then the lender can see 12 months of this and
Absolutely.
not
Yeah.
go against you.
We've come across that many times, and same with business owners too. Business owners have company vehicles that they write off.
Yeah.
Hey, it's a great write off for your company, but it's signed on by you personally, and it shows up in your credit report. That's something that maybe somebody at the bank maybe not know, and they're going to qualify you for a lot less.
Yeah.
Somebody like myself can come in and ask those pointed questions. Who's making this payment? Oh, it's my business car. I write it off on my taxes. Great. Let's prove that it's paid out of a business account, and I can exclude it, and then that gives you that more buying power.
Well, again, you got a couple of tips about the loans, which one you should go for, which one maybe interests you. You got some tips on what you should not do. And that's what you get when you, again, ask questions. You come in, you sit down with your realtor, with your lender, somebody who has a vested interest in you getting a home. Mark, again, thank you very much for coming out here,
Absolutely.
taking the time, sitting down with us. I really appreciate it.
Yeah.
And we'll put all of Mark's information on there. We'll tag him. If you want to reach out to Mark, you can go directly to him, or you can reach out to us,
Yeah.
and we'll put you together. We'll get you a loan and get you into a house soon.
Absolutely.